The retail trading revolution hinges on a single, counterintuitive fact: zero commission trading is not free. When a brokerage firm advertises $0 per trade, the client effectively becomes the product. This economic model is sustained by payment for order flow, or PFOF, where the broker sells the right to execute your trade to a specialized third party, typically a high-frequency trading firm acting as a market maker. This transaction occurs milliseconds before your order reaches a public exchange. The market maker pays the broker a fraction of a cent per share for this predictable stream of retail orders. This arrangement bypasses traditional exchange fees and allows the broker to monetize the information asymmetry inherent in retail trading. Understanding PFOF is essential to grasping the true cost structure of modern financial technology platforms. PFOF is the compensation received by a broker-dealer from a market maker for routing customer orders to that market maker for execution. The broker-dealer acts as an agent for the customer, but receives payment from the principal executing the trade. This practice is distinct from traditional exchange rebates, which are paid for providing liquidity. PFOF is paid for directing liquidity demand. The market maker benefits because retail order flow is considered uninformed, meaning these orders are less likely to move the market against the market maker compared to institutional orders. This predictability allows the market maker to manage inventory risk efficiently and guarantee a profit margin on the transaction. Market makers, often high-frequency trading firms, profit by capturing the bid-ask spread. The spread is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. By internalizing retail orders, the market maker executes the trade at a price slightly better than the National Best Bid and Offer, or NBBO, but still captures the majority of the spread. For example, if the NBBO is 10.00 bid and 10.01 offer, the market maker might execute a buy order at 10.001, providing a fractional price improvement to the customer while retaining 0.009 cents per share as profit. This small margin scales massively across millions of daily retail trades. Internalization refers to the market maker executing the trade using their own inventory rather than routing it to a public exchange. Regulatory requirements mandate that brokers must achieve best execution for their clients. In the context of PFOF, best execution is often demonstrated through price improvement. This improvement is typically measured in tiny increments, often less than 1 cent per share, relative to the NBBO. While the customer receives a slightly better price than they would on a public exchange, critics argue that the speed and scale of internalization prevent the order from interacting with the broader market, potentially missing a superior price that might have been available momentarily on an alternative venue. The regulatory focus remains on measurable price improvement versus the opportunity cost of non-interaction. The PFOF ecosystem relies heavily on advanced technological infrastructure provided by high-frequency trading firms. These firms invest heavily in co-location, placing their servers physically adjacent to exchange matching engines to minimize latency. This proximity ensures that the market maker receives the retail order flow and executes the trade before the public market price can shift. The technological advantage is measured in microseconds. Sophisticated algorithms analyze the incoming order flow, determine the optimal execution price based on current market depth and volatility, and execute the trade almost instantaneously. This low-latency environment is the core technological enabler for profitable internalization and spread capture.
PFOF represents a significant but not exclusive revenue stream for zero-commission brokers. For some brokers, PFOF can account for up to 40% of total revenue. Other critical revenue sources include margin lending, where brokers charge interest on funds borrowed by clients to purchase securities. Securities lending is another major component, involving the broker lending out fully paid client shares to short sellers in exchange for a fee. Finally, cash sweep programs generate income by investing uninvested client cash balances into low-risk instruments, retaining the difference between the yield earned and the interest paid to the client. PFOF allows the broker to offer a seemingly free service while monetizing the client relationship through multiple channels. The Securities and Exchange Commission, or SEC, regulates PFOF primarily through Rules 605 and 606 of Regulation National Market System. Rule 606 mandates that broker-dealers publicly disclose the venues to which they route customer orders and the compensation received from those venues. This disclosure must be made quarterly and is intended to provide transparency regarding PFOF arrangements. Rule 605 requires market centers to publish monthly reports detailing execution quality statistics, including effective spread, price improvement, and speed of execution. These rules aim to ensure that the practice of PFOF does not compromise the broker's obligation to seek the most favorable terms reasonably available under the circumstances for the customer. The primary criticism of PFOF centers on the inherent conflict of interest. A broker is incentivized to route orders to the market maker offering the highest payment, rather than necessarily the market maker offering the best execution quality for the client. While regulatory rules require best execution, critics argue that the financial incentive biases the routing decision. Furthermore, the practice allows market makers to aggregate and analyze retail trading patterns, giving them a proprietary informational edge. This debate intensified following the 2021 meme stock events, prompting the SEC to consider potential changes, including implementing an order-by-order auction mechanism to increase competition among execution venues. PFOF is not universally accepted. The practice is largely concentrated in the United States. In the European Union, the Markets in Financial Instruments Directive II, or MiFID II, introduced strict rules that effectively prohibit PFOF for most transactions. MiFID II requires investment firms to take all sufficient steps to obtain the best possible result for their clients, and receiving third-party payments for order routing is generally viewed as incompatible with this obligation. Germany and other member states have historically allowed limited PFOF, but the European Securities and Markets Authority has pushed for a complete ban, citing the conflict of interest and lack of transparency. This divergence highlights differing global views on market structure integrity. The future of retail execution may involve significant structural changes driven by regulatory pressure. The SEC has proposed rules aimed at increasing competition for retail orders, potentially requiring certain orders to be exposed to competitive auctions before internalization is permitted. If implemented, such rules would fundamentally alter the economics of PFOF by reducing the market maker's ability to guarantee spread capture. Brokers would face pressure to find alternative revenue streams or potentially reintroduce small commissions. The sustainability of the current zero-commission model depends entirely on the regulatory tolerance for the informational advantage and execution efficiency provided by the current PFOF structure.